The following is a sponsored program paid for by First Alliance Credit Union. Welcome to Good Money Moves, featuring Jenna Taubel from First Alliance Credit Union and Andy Brownell. Here's Andy Brownell on Rochester's News Talk, 1340 KROC AM and 96.9 FM.
It is time for Good Money Moves. I'm Andy Brownell with News Talk 1340 KROC AM and 96.9 FM. And of course, I'm with Jenna Taubel, AVP of Marketing with First Alliance Credit Union. Hello, Jenna.
Hi, Andy.
Hope things are well with you.
Absolutely. How about you?
Yeah, doing well. Last week on the program, we navigated through smart financial planning. Mm-hmm. What are we going to explore this week on Good Money Moves?
Yes. Well, in some recent episodes, we have discussed a few different topics around car loans. We talked about like the important questions you should ask when you're buying a used car. We've talked about even the benefits of refinancing an existing car loan. And so today I did want to just dig back into that topic a little bit around buying a car. And if our listeners remember in one of our previous episodes where we talked about this, I did share some stats on the current cost of vehicles and really pointing out why buying a car is really a major financial decision for a lot of people at this point, with the average used car price this year currently is sitting at around just over $25,000.
That amazes me.
Yeah, it's high. And of course, there's a range, right? That the cost of a vehicle matters a lot with the, make, model you're looking for, that kind of stuff. Is it just a basic model or a luxury? So really that average range, is closer to like $18,000 for maybe a small sedan up to like $33K for something like a used like luxury SUV or a pickup truck. And some, of course, these are averages. So Some are going to be less than this, some are going to be more. There's a lot of factors that go into the price of a vehicle. But at the end of the day, with that much money on the line, I felt it was just really important to kind of delve back into this topic again, but really kind of talk more about how to afford a vehicle in today's episode, and really do that by focusing on a couple of key pieces, and that is budgeting and credit score.
Okay.
And
I think budgeting might be the focus. Know what you're getting into before you get into it.
Mm-hmm.
Okay. So what are the factors that would affect your car loan payments?
Yes. Yeah. I'll say there's like three key factors that really affect how much your car payment is going to be ultimately. Number one factor for how much your car payment is going to be is the amount of money that you need to borrow to purchase that car. And you can kind of influence this component in two main ways. One, by purchasing a less costly vehicle. And two, by making a bigger down payment, thus decreasing the amount that you're going to need to borrow for that vehicle. So while you can't necessarily control the actual cost of the car that you're buying from a private party or from a dealership, you can influence the actual amount that you need to borrow by making some key decisions before you purchase, right? So by looking at those less costly vehicles, or by making sure you have a sizable down payment to minimize the amount that you need to borrow and then repay and make those payments on.
You got to give a lot of thought to the cost of the vehicle, because if you really try to, I guess, go cheap, then you run the risk of buying an unreliable vehicle.
Exactly. Yeah. It's not as easy as, I'm just going to buy the cheapest thing out there. That's not always the best case either, because then you just end up paying out a lot in maintenance fees or having to buy a new vehicle again even sooner. So there's a balancing act to this. But that is one area of influence that factors into how much your car payment is going to be. The other factors have to do with the loan. And again, there's another factor in here that you can kind of tweak. So the length of your car loan plays into how much your payments are going to be in that. a shorter term. So if you think you can get car loans for as little as like 12 months, 12, 24 months, 36 to 60 months is probably the more common. Some financial institutions will even finance cars up to like 72 months in some cases. So the longer that your term is, the smaller your payment's going to be. So, and this is because you're stretching out, let's say if you had a $10,000 loan, if you're stretching that out for 36 months, that you're going to have to repay that faster versus if you stretch it out for 60 months, which is like 5 years, which is common car payment term. So shorter terms mean you're making fewer payments, but it's going to increase the amount you pay each month. Those longer terms are going to lessen the amount that you pay each month, but you have more payments to make over time. And that also can actually lead to more interest paid over time as well, which leads me into the third factor I wanted to talk about when it comes to car loans and what affects your payment. And that is the interest rate that you are going to qualify for. And your interest rate is tied to two factors, your credit score and, going back to what we just talked about, the length of the loan that you choose. So if you have a really good credit score and you're choosing a shorter term loan, your interest rate is going to be the smallest end of whatever that spectrum is for that particular lender you're working with. If you have more of a fair credit score, maybe one that's like 601 to 660 or something like that, and you are taking out a loan for a longer term, let's say that's 60 months, you're going to end up on that higher interest rate spectrum for what you're going to end up paying. So these two factors kind of work together a little bit.
Well, sure. And then you get the double whammy if you don't have the excellent credit and you choose the longer payment option because that's what works with your budget. You're going to end up paying much more in interest.
Yes. Yeah. Absolutely. This is why it's really important to think about improving your credit score before you take out any type of loan, but vehicle loans especially. So even just like, let's pretend your credit score is 640, even getting it up to like 690 is enough to maybe change this tier of your credit score that you're in. And it can drop your interest rate pretty significantly. So, I mean, for example, you might be moving it from that 10% rate to a 7% rate. And if you think about that, it doesn't seem like a huge difference, but when you talk about it in terms of the loan that you have, a rate on, a $30,000 car loan, that difference between that's a 3% difference. You could save almost $2,000 in interest alone over like a 5-year term, which that's not a small chunk of change either. So that's actually real money back in your pocket. So this is where being thoughtful about taking out car loans and understanding the impacts and what you actually have a little bit of control over can actually help you make some really good decisions. So if you think about how much you can really afford to borrow, and maybe you buy a less costly vehicle or make a bigger down payment. That's going to help you kind of adjust how much you're ultimately going to owe, which greatly affects what your payments are going to be. If you can afford to pay a little bit more upfront and choosing that shorter term, you can save yourself a lot of money. Even if you are making slightly larger payments over time, you're going to pay it off faster and ultimately pay less interest over the life of that loan. And then just really focusing in on your credit score before you apply. And if you're kind of on the edge between two score tiers, maybe wait 6 months and really focus in on improving that score. You will save yourself so much money just by getting a better interest rate because you've improved your credit.
And when you talk about these interest rates and the cost of the interest based upon your credit scores and how you can improve them, when you think about it, you could factor that in. I mean, if it's a $30,000 vehicle, you should actually consider over the life of the loan what you're paying in interest and add that to the actual cost of the vehicle.
Yeah,
in
absolutely.
Your considerations.
Mm-hmm.
And I know that when you see the advertisements, a lot of the dealers, they'll advertise you can get into this vehicle for only so much per month, but you're right, that's going to be that 60-month or 72-month loan that gets that into you, for that payment. And I'm sure before we're done today, we're going to incorporate the budgeting part of this, and
absolutely.
considering all the things I just mentioned, including the down payment part of the equation.
Yeah.
In your budgeting equation. Okay. So we're talking about financing a new car, or not a new car. We're talking used cars at 25 grand or more.
Yeah.
In ways we can do it smarter and better, and make good money moves when making these types of large purchases. Jenna Taubel with First Alliance Credit Union is here, and I'm Andy Brownell. Good Money Moves continues in a moment on News Talk 1340, KROC AM and 96.9 FM.
Good Money Moves continues in moments with Andy Brownell and Jenna Taubel from First Alliance Credit Union. This is News Talk 1340, KROC AM and 96.9 FM. We're talking good money moves with Andy Brownell and Jenna Taubel from First Alliance Credit Union on Rochester's News Talk 1340 KROC AM and 96.9 FM.
Welcome back. Good Money Moves. Andy Brownell with Jenna Taubel with First Alliance Credit Union. And the topic today is, I guess, putting together the best financing package for purchasing a new or used vehicle that fits your budget.
Yeah.
To sum it up, and you mentioned before the break how pushing up that credit score can make a big difference over the life of a loan as far as how much you have to pay. And I guess that leads me to the question of, how can I do that? How can I improve that credit score?
Yeah, that's a really good question, Andy. And to your point, improving your credit score can make a substantial difference in the affordability of your vehicle. So there's some key things that you can do if you're kind of like, oh, I want to buy a new car, but I need to improve my credit score first. A couple things to think about are, well, number one, pay your bills on time. This is probably the most significant factor. So if you're just a few days late, sometimes that can impact your score, especially if it's a consistent thing. If it just happens like once or twice throughout the life of the loan, it's probably not going to have that big of an impact. It's if you're consistently paying your loan payments or your credit card payments late, that's going to start to impact your score quite a bit. Question
on that.
Yes.
When is it considered late? Is it any time past that due date, or is there, like a grace period?
Yeah, there are grace periods built into credit cards frequently. Sometimes it's like 10 days. But it depends lender to lender. Some are more lenient than others. So just that's kind of where before you sign on the dotted line, make sure you understand what on time means for that lender. Some lenders might give you a grace period, but still knock you for being a day late. So just be clear on that. It varies.
Well, the automatic payments should take care of that problem anyway.
100%. You read my mind. Yeah. If this is a challenge area for you, setting up reminders for yourself or scheduling those automatic payments are going to really ensure that you never ever miss that due date. And it can actually be really helpful in kind of alleviating some of the stress of, oh, I got to remember to make this payment, or, it can just kind of automating your payments and your budgeting really does free up a lot of mental bandwidth and stress for you.
I agree.
Now, another factor in your credit score that can help improve it is to actually reduce the amount of debt that you actually have. And this is around the idea of credit utilization, which we've talked about before on this show. But what that is, essentially, it's a percentage of the available credit that you're using. So if you have a credit limit of $10,000 and that balance is $3,000, you're utilizing about 30% of your available credit. So ideally, it's best to keep this under 30%, and this is really what shows lenders that you're managing your credit responsibly. It's showing that, hey, I have this huge limit, and you might even sometimes actually use that entire limit depending on what you're purchasing. But if over time and generally speaking, you're keeping that at under 30%, that's going to positively impact your score. on top of making those on-time payments. So if you look at your credit score and you look at your kind of makeup of what your different debts are, if your utilization ratio is like 50%, I would not recommend going out and getting more debt through something like a car loan. First, focus on aggressively reducing your debt and really lowering that utilization rate, and that's going to actually help improve your score over time.
Now, on a monthly basis,
Yes.
say you use a credit card to pay, your groceries, your everyday expenses.
Yeah.
And on a regular basis, that exceeds that 30% utilization rate, but you pay it off every month. Does that come into play at all on your credit score, or does that kind of paying it off mitigate that completely?
It really wouldn't necessarily, and I say necessarily because if you're carrying that balance over a month end or a payment period when the institution that you have this credit card through submits your information to the credit bureaus and you're carrying that balance, and that happens frequently, it might start to look like you're carrying more than that 30% ratio. But if you, generally speaking, if you're paying that down monthly and you're maybe, to your point, using it for your basic everyday type stuff and then paying it down immediately, the majority of that's not going to show up on your credit report because they're only sending that information once a month. So it's kind of a snapshot.
I'm just thinking people who use the reward cards.
Yeah. Yep. No, it should not negatively impact your score. Generally speaking, there's always those outlier situations.
Okay.
But the idea of a credit card is that you use it to help you get through, times when you might be a little bit short on cash, or you use it to boost your rewards or things like that. But it's all about that. I'm going to use it, but I'm also going to pay it off quickly and on time.
Right. So that's the real pattern they want to see.
Yes.
Okay. What else is out there for boosting my credit score?
Yeah. So a couple other things to think about would be if you're planning on applying for a vehicle loan, and this is true for mortgages too, really, really important if you're applying for a mortgage even, is avoid applying for new credit right before this, right? So if you're like, I really want to get a new car, don't go open a new credit card first. That is going to start to chip away at your credit score as well, because each application that you apply for, you're giving them permission to pull your credit. And if the credit bureaus start to see that you're doing this in rapid succession or with multiple different lenders, it's going to be a red flag, like, and it's going to impact your score. It's going to dip. So it's going to be a red flag for lenders because it's like, what is this person trying to do? Why they're applying at all of these places? So that's something to be mindful of. It's not going to be a huge impact, but if you're already kind of on the line and you're trying to improve, definitely don't go applying for new credit accounts before you're trying to get something like a car loan or even a mortgage. Another thing, check your credit report, right? It's really essential that you're doing this regularly anyway, and it's a great opportunity if you're thinking about getting a new vehicle and applying for a loan. Take that opportunity to get your free credit report. You can do that from annualcreditreport.com for free from all three of the credit bureaus, and go through it. Look for any inaccuracies and dispute them. Because if there's something on your credit report that shouldn't be, and it's likely negatively impacting your report, and you don't want that on there, that can be a great way to improve your score, is by finding things that shouldn't be on there, because it does happen more often than you think. So don't assume that it's reported accurately, especially if you have a common name or you share like a family name, like you're a junior in the family, right? That happens a lot. So those are some things to think about too. And then lastly, I'll just say, it can be really tempting to close older credit accounts if you're not using them. But if those accounts aren't negatively impacting your score as it is. They're just sitting there. And you have had positive payment history on those accounts over time, and maybe just as of recently you stopped using them or in the last year or two, leave them there because the length of your credit history also hugely impacts your score. So it can be actually detrimental if you've got, let's say you had a credit card for 10 years and you recently stopped using it as frequently. If you remove that, maybe that's your oldest piece of credit on your credit report, that's you all of a sudden, let's say you had that for 10 years and then your next one you maybe got 5 years later, you just took half of your credit history and removed it off of your credit report. So that can really, really impact it too. So just be mindful of that as well.
All right. We do need to take a break. We'll come back with more Good Money Moves, talking about putting yourself in a great position financially to get that vehicle loan if you're looking and shopping for a used vehicle. Back in a moment on News Talk 1340 KROC AM and 96.9 FM.
Good Money Moves continues in moments with Andy Brownell and Jenna Taubel from First Alliance Credit Union. This is News Talk 1340 KROC AM and 96.9 FM. We're talking Good Money Moves with Andy Brownell and Jenna Taubel from First Alliance Credit Union on Rochester's News Talk 1340 KROC AM and 96.9 FM.
Good Money Moves continues. I'm Andy Brownell with Jenna Taubel with First Alliance Credit Union, and we're talking about, getting all your ducks in order to purchase that new vehicle.
Yes.
Get a down payment, make sure you can afford it, get your credit score up, and I guess the other key thing in all of this, and probably the most important part, would be budgeting for it.
Yes, absolutely.
How should I plan for purchasing this vehicle?
Yeah, budgeting is a crucial step when you're preparing to buy a car. Obviously, budgeting is a crucial step for every moment in your financial life. That's what we're here to talk about all the time, right? But as a reminder for our listeners, to determine your budget for anything, you need to first calculate your monthly income and then calculate your expenses and figure out, how much money do I have to put where. Now, when we talk specifically about a vehicle loan, you want to ensure that your car payment does not exceed 15% of your monthly income. So for a quick example, with a $3,000 monthly income, this means keeping your car payment around $450 or less, right? $450 would be the max.
Okay.
And you also don't want to forget when you're budgeting for the cost of a vehicle, don't forget to include, additional costs like insurance, which can add another like $100 to $150 a month, depending on the coverage in the vehicle and what kind of driver you are. Also, that kind of 15% mark is a rule of thumb. So if you have other bills or debts that you're paying on, a $450 a month payment might be too much. So you really have to balance your needs versus what you can afford, because you do not want to overstretch your budget and leave yourself in a spot where just paying for your vehicle is becoming strenuous on your budget. You want to make sure that it fits nicely in there without stressing you. So you might want that newer pickup truck, but if your budget can't accommodate that, you might have to look for something maybe a little bit older or with higher miles, or maybe a more basic model of a vehicle than you originally thought. So those are some things to think about when you're figuring out what can I actually afford. And how much down payment you can afford is another thing to think about. A lot of people will exhaust their savings to make a down payment, but that is not necessarily a best practice, right? The more you can put down up front, the better, yes. And a substantial down payment definitely reduces the amount you need to borrow, and again, can lower your interest rate too, because you can maybe afford a different term like we talked about earlier. But you really should not use up your entire savings to make a down payment either, because you still want to make sure that you leave yourself with some buffer, for those emergencies. You want to still make sure you have some money left over once you purchase this vehicle. You don't want to bring your savings to zero
Right.
over buying a car if you can help it. So,
And that's where you can budget for it too. If you think far enough in advance, you can start putting money into an account for
yes.
that down payment way
Hmm.
ahead of when you need to purchase it.
Absolutely.
Okay.
Absolutely.
So I've got it budgeted. I know what I can afford. What's the next step?
Yeah. So, a couple other things to think about when it comes to actually, I guess, securing the best auto loan for the budget amount that you've determined you can afford. Um, Make sure that you're taking some time to compare different lenders, right? Local credit unions are really great places to go for auto loans. They typically have really flexible terms, um, lower interest rates than you're going to find elsewhere. First Alliance Credit Union is obviously one of those to check out. But also take some time to use some like online payment calculators to really see how different rates and terms are going to affect your payment. And also be mindful, financing through a dealership, um, it can actually be more costly than if you went direct to a credit union or a bank, because dealerships shop your loan to multiple lenders to help you get approved and help you find a good rate, which is a nice convenience. But you do actually end up paying a higher rate through the dealer than you would if you had just gone direct to that financial institution, that credit union. So something to be mindful of there too. You also want to make sure that you're understanding the total cost. And we kind of mentioned this a little bit earlier when we were talking about budgeting, but look beyond just that monthly loan payment. Consider the total cost of the loan, including the interest over time. A lower payment might seem appealing, but it could mean a longer loan term and more interest paid over time. Some other things to think about when it comes to, understanding the total cost. We mentioned insurance, and there's actually some add-on insurances that you can consider for vehicle loans as well that can be actually extremely beneficial. So two of them that we offer very affordably here at First Alliance is something called gap coverage, which helps if you end up owing more than the vehicle is worth, and you maybe get into an accident where that vehicle is no longer usable. This gap coverage can come in and help you kind of get your finances in order to help pay down that difference on your loan, so you're not having to pay more than the vehicle's worth if you no longer own it. Another one that can be really beneficial is debt protection, which debt protection helps cover your loan payment in emergency situations, like if you are ill and can't work or you lose your job, are some of the things that are covered under that. And we've had a ton of members who have opted for that and have ran into these life situations, and it saved them and saved their finances significantly. So those are some things to think about too, kind of future proofing. But another thing to think about too is getting pre-approved before you even head to a dealership to start shopping. Getting pre-approved for your auto loan really helps you know exactly how much you can afford, and it shows the sellers that you're a serious buyer. But what it can also do is it can also help, lock in your interest rate for a set period in a lot of cases. So if interest rates are really volatile, it can be really helpful for you to make sure that you know exactly what your payment's going to be should you opt to utilize that full pre-approved amount. And mention this early in the show to make sure you're reading the fine print, really carefully understand the terms and conditions of the loan that you're getting. Be aware of any additional fees that are attached to that, any prepayment penalties that might apply or other conditions that might affect your actual payment schedule. Just be really aware of those. And then if you are struggling to get qualified, one thing to think about is, if you just can't get that credit score up as high as you would like, you could consider a co-signer on the loan to help it become a little bit more affordable for you. So you could consider asking a family member with good credit to co-sign with you, and which will just help you really secure a better rate. But remember, it is a significant kind of responsibility on the co-signer's part because they are now on the hook for that loan as well. So if they tell you no, don't take it personally. They're just trying to protect themselves.
All right. And I'm sure there's a ton more information out there if we had time to cover it. So I guess where can we look for that information to make sure we're making good money moves?
Yes, as always, I encourage our listeners to visit our website at firstalliancecu.com. You can subscribe to our blog. We release new financial tips and advice there weekly. You can listen to past episodes of this show at firstalliancecu.com/podcast or on krocnews.com. You can also subscribe to Good Money Moves on Apple Podcasts, YouTube Music, and Spotify. And as always, I encourage our listeners to reach out to our team at First Alliance Credit Union. We are here to help you start making good money moves today.
All right. First Alliance Credit Union, federally insured by NCUA and an equal housing lender. Jenna, thanks again, and I look forward to another Good Money Moves next week.
Absolutely.
Right here at News Talk 1340 KROC AM and 96.9 FM.